Hello and welcome to this episode of Mutual Fund Masters. Joining me today is Navin Agarwal, who's the Managing Director and CEO at Motilal Oswal Mutual Fund. Thank you very much, Navin, for taking time out to speak to our viewers in these very difficult times. We'd first like to understand from you what is the philosophy of the fund house that you want to bring to the table, any changes you seek to do in the way the fund house functions.
Thank you, Vivek, for having me on the show. So, as you're aware, Motilal Oswal started managing money, for public about 17 years back. While we started, our wealth creation journey or wealth creation studies by our co-founder Ramdev Agarwal in the year 1995, which is 25 years back, right? So, and Ramdevji's own, guru is Warren Buffett, and he has been on a pilgrimage to Omaha year after year for the last many years, and we've been taking dozens and tons of our investors along with us, to Omaha as well. So our philosophy is very, we've time traveled and honed our philosophy over the last 25 years, right? And from a stage where we used to own a lot of stocks, we started owning fewer stocks. We had realized the importance of quality. Next came our learning on longevity. Over a period of time, we added the spice of growth to it. And so over a period of time, this whole QGLP investment philosophy got formed. But as strategy is, one part of the, overall business, but execution is extremely important. And as an AMC, we grew from 1,000 crore assets to 45,000 crore assets, right? 45x in literally 5 years. And such a rapid growth in your assets brings with it a lot of learnings as well. So what we've done is the QGLP philosophy remains the same, but the execution of the QGLP philosophy is what we've tightened. We've got a much larger investment team, a dozen-member, research team, which works very closely with the fund managers, the portfolio managers, to test the QGLP validity on all of our holdings on a half-yearly basis. Also, the scuttlebutt is conducted with a lot more rigor and intensity, right? We've put together a very empowered investment committee that interacts with the fund managers. We've got very structured reviews. We've created what we call the portfolio monitoring templates. So basically, there's a lot more objectivity to be able to see through the compliance, the execution of this, QGLP philosophy. And the last thing that I want to tell you is that there's a lot more teamwork that we've added. So we have a whole bunch of great ideas, right? Multi-baggers. So as you know, the definition of a multi-bagger or the prerequisite of a multi-bagger is your vision to be able to see it, courage to buy it, and patience to hold, right? And we have Page Industries, Eicher Motors, Bajaj Finance, Voltas, and tons of these names which have contributed to our performance over the course of these last 2 decades, right? What is really required is to cross-pollinate these best ideas across your portfolio. So through pre-mortem sessions, through cross-pollination sessions, across our 24 investment team, a dozen research team members, and a dozen portfolio managers and fund managers, we bring them together and spend hours and hours together to ensure that our best ideas have a greater reflection in the portfolio. So, dialed up on execution, dialed up on processes, dialed up on teamwork. These are the changes, while the overall philosophy, like it has evolved for the last 25 years, will continue to evolve over the next 25 years. So as we learn newer frameworks, Vivek, value migration was one such big framework that we came across through the book of Adrian Slosky, right? Next $1 trillion opportunity was a framework that we added about 13 years back. So history is replete with adding these frameworks. And while many of the managers you may speak to have a traditional, great business, good management, right valuation model, we believe that frameworks help us tremendously, right, to guide us through the ups and downs of the markets, and we will continue to add to these frameworks over a period of time. By the way, we finished our Silver Jubilee, wealth creation study very recently, And Ramdevji presented that study to the world. And all these 25 frameworks that we've collected through these 25 studies are available on our website for you and all your viewers, to take a look at. And they've helped us immensely in terms of generating our performance over the course of the last 2 decades.
Naveen, we live in very difficult times. There's a lot of pain out there, in society right now, including financial pain. What should investors, according to you, be doing in these difficult times? On the one hand, there is acute volatility. The ability probably to keep investing is, sharply reduced with the loss of income, with loss of jobs. What can an investor do at this point of time?
Well, there are a lot of things that you can do, in the stock markets, but one of the strategies is also to not do anything. So, when you respond to a pandemic, you may recollect, Vivek, that the first response to the pandemic last year, when the markets crashed in the month of March, was the beginning of selling by retail investors out of mutual funds, right? And we had about 9 months of outflows, from mutual funds by the domestic investors. And in hindsight, domestic investors sold from 8,000 Nifty all the way to 12,000 Nifty, right? And so, from 13,000 Nifty pre-COVID, we came down to 7,000 Nifty. We are up to nearly 15, 16,000 Nifty today, right? And a lot of money exited the markets at that time. So doing something about the pandemic, robbed you of the entire recovery that you saw in the marketplace. We believe that whenever an investor responds to a change, so for instance, let's say the COVID wave 2 is getting over, right? Let's load up on economic recovery or opening up trades. Let's buy banks, let's buy cyclicals, or let's say the global metal prices are going up or material prices are going up. Let's load up on that. When you respond to these events, after they are well known, right, you often don't make any money out of those trades. You have to be positioned ahead. You have to have your own philosophy of what you will do and what you will don't. And so too much activity, in these times can actually rob you of a lot of gains, because these are very volatile times, as you saw, the kind of range of market movement that you've seen, and the kind of rotation across sectors, from in the first round technology and pharma stocks doing really well, and then in the next round more and more sectors getting added to that rally. And now, ever since the budget got presented, you have the infrastructure, capital goods, lenders, all those names also starting to do very well. Really, it is almost impossible for an individual investor to jump across every such opportunity, to navigate through this volatility, to do a lot of action, and still be able to add any worthwhile value to the portfolio. So really, we believe in the buy and hold philosophy. We believe in concentrated portfolios. We believe in low churn, and we believe that any investor who follows some of these principles or rules generally should do well over long periods of time. Let me just give you one last example. So if you had bought into Nifty, right? If you had put ₹1,00,000 in Nifty 30 years back, right? That 30 rupee, that 1 rupee would become 1,00,000 rupee would become, let's say, 31 lakh rupees, right? And if you had missed the 30 best days during this 30-year period, right? Then that 1 lakh would not go up to 31 lakhs, but would go up to only 3 lakh rupees, right? So your experience, you would have lost 90% of the gains by staying out for less than 1% of the days. And guess what, Vivek? 18 out of those 30 days were hidden in the middle of a bear market, not in the middle of a bull market. So some of the biggest rallies in the markets, like you saw in the last 12 months, happen in the midst of a correction. And so if you try to time the market, and timing the market can take away a lot of this upside. In this case, as I explained to you, timing of the market took away 90% of all your upside. And in which case you start blaming equities, and you start wrongly believing that debt will do better than equities or other asset classes will do better than equities. It's not that other asset classes will do better than equities. It is your conduct which makes the other asset classes look better than equities. So it's not really timing, it's really time in the markets that allows your money to compound over long periods of time.
Naveen, you're a pure play equity fund house. You only do equity related schemes. How important is equity according to you in a portfolio? And how can a first time investor who's listening to you, what kind of a portfolio construct would you recommend for a beginner?
Right. So, Vivek, if you were to Google what should be the asset allocation split between debt and equity, you'll find a lot of wisdom through Google. And I don't believe any of it. So let me tell you what will you find on if you Google this up. So there will be a very simple formula about how your allocation should be between debt and equity, and the formula is as follows: 100 minus your age should be your equity allocation. So let's say if you're 80 years old, 100 minus 80 is equal to 20% should be your equity allocation. And say if you're 20 years old, in that case, 100 minus 20, which is equal to 80%, should be your equity allocation. I don't believe in this at all. I'll tell you why. And I'll explain to you my formula, right? For the benefit of your viewers. I feel that any amount of money that you need to consume, right, or to make an investment, right? Let's say you want to buy a house, you want to fund your child's education abroad, or you want to spend on your children's wedding, you want to spend on holiday, you have a certain amount of expenditure every month. You take out all that you need by way of consumption and investment needs, right, which cannot be postponed. Non-postponable consumption and investment needs over the next 7 years. You set that amount aside and you can invest them in fixed income. Now you know that the real value of that money that you've set aside is unlikely to grow, right? With that full knowledge, you set it aside because you cannot forego or postpone that consumption or investment need of yours. Everything else should be in equities. You can look at 100 years history, you can look at 50 years history, you can look at 20 years history. Equities trumps all asset classes. If you look at the richest people in the world, they typically are one stock investor, whether it's Jeff Bezos, etc., right? Or you have successful investors like Warren Buffett, right? But basically, equities is the only way to beat inflation, to augment your real purchasing power. Everything else actually depletes your purchasing power over a period of time. Now, that's something that is very important. And that is why a poor person should never invest in equities, because he's going to consume out of his savings. And a rich person should never invest in fixed income, because he is going to consume out of his income. And he can set aside whatever part of his wealth he needs to consume or invest, and which cannot be rescheduled, right, over the next 7 years. But everything else must be in equities. Otherwise, that part of the wealth is actually eroding in terms of real purchasing power. This is something that is difficult to digest, but let me tell you that we practice what we preach. At Motilal Oswal, I have 100% of my wealth. Our firm has 100% of its wealth. Our promoters have 100% of the wealth. Our key employees have 100% of their wealth in equities. And also keep in mind that the mentality is to really start investing at a certain age. If you see a person retiring at the age of 65 will really start making worthwhile investments at the age of 45. Let me give you a simple math. I know money doesn't compound at 20% usually, but I'm just taking a number, and you can take any other number. You can take 10, 15, but I've done the math for 20%. So if you start investing at the age of 45, right, and if you invested just 1 lakh rupees, right, and your money is compounding at the rate of 20%, then your 1 lakh will become about 36 lakhs, let's say just short of 40 lakhs at the age of 65. Guess what that 1 lakh rupee would have become if you had invested that at the age of 15? Vivek, you want to take a guess at that? You want to take a shot at that? 1 lakh at the age of 45 became 40 lakhs. 1 lakh, the same 1 lakh at the age of 15 became how much? 91 crores. You can do it on your calculator. right after this. So all you have to do is put 1 lakh into your son's account, and maybe it will not compound at 20%, maybe it will compound at 14, 15%. But that money will still be into crores and crores of rupees, far in excess of whatever you can imagine. So that's the advantage. That's the, say, I want to leave you with one little story here, right? Buffett is worth, let's say, about $100 billion. Vivek, 90% of that $100 billion has been made after the age of 60, right? And he started from zero at the age of 15, and he's been fully invested. Your question about what should be the asset allocation, etc. He was not a rich guy at that stage, right? He had no wealth. Okay. He invested at the age of 15. The math that I just spoke about, 1 lakh becoming 91 crores. And he's 90 plus, you're aware right now, right? He's 92. And he's worth about $100 billion. More than 90% of that wealth was made after the age of 60. And guess what? If, like an average American, if he had started investing at the age of 25, and if he quit at the age of 65, do you want to again take a guess versus this $100 billion? How much would Mr. Buffett be worth today? $12 million. Less than 12. It's $11.5 million. He's worth 100 billion now. So do you see the magnitude of proportions? I mean, we always worry about equity or debt, bull market or bear market, this manager or that manager. The $1 million question is how much time, how much patience you're supplying to your investments. So really, they say that IQ is 10%, temperament is 90%. What is temperament? Temperament is to be greedy when others are fearful. So in March of last year, everybody was fearful. That's temperament. You don't need IQ. You don't need to know that Hindustan Unilever is a good company or HDFC Bank is a good. You don't need to know that. You just need to manage yourself, your own behavior. When a fund does badly, what is a typical investor reaction? To withdraw money from that fund. And when does he put money back into that fund? When it does well. So what are you doing? You're rear view mirror driving. You drive your car, Vivek, looking at the rear view. Shut your front screen. You meet with an accident. That's how most people are investing today. And that's how most people are advising today. They're looking at the rear view returns, which is a very poor indication. In fact, SEBI, the regulator, is kind enough to post in every advertisement, in every collateral, that past performance is no indicator of future, right? But we extrapolate that.
One final question, Naveen, with you, which is, we've seen recently, at least in the last year and a half, a trend, where individuals are probably preferring to go directly into the stock markets by, investing through brokerages. You own a brokerage as well. Instead of probably coming through the mutual fund route. Is this a trend that you worry about from the mutual fund industry's growth point of view, but more importantly, from an investor's point of view of making mistakes by trying to go and pick stocks on your own without probably the adequate knowledge that you should have?
Yeah. So this whole do-it-yourself approach to investing, Vivek, if you need a haircut, you could do it yourself. But you go to the barber, right? And it's not a very value-added job. There are millions of barbers in the city of Mumbai, right? But investing is far more complicated. And it is not even a test of IQ, it's a test of temperament, right? Will that investor possess the nerves of steel, the temperament to be greedy when others are fearful? When markets are crashing left, right, and center, and headlines are that a pandemic has hit the world and Nifty is closing limit down and there's red all over your screen, will you stand up and buy? Correct? Now that's something so I can only tell you that there are thousands of doctors in the city of Mumbai. There are thousands of barbers, and you don't do it yourself there. Why would you do it yourself here? This is a far difficult, far rarer skill compared to many of those other things. And the last thing that I'd like to tell you is that I'm not worried about the growth of the mutual fund industry at all, Vivek. I'm really worried about adding investors to the base of the, because see, your magic of compounding, it's very unfortunate that foreign investors own more of the Indian equities than retail domestic investors. So who's making the most of the wealth creation that's happening in India? Who's making the most of the 31 times that happened in Nifty over the last 30 years? It's really the foreign investors more than the domestic investors, right? So basically, I worry about those investors who, based on their do-it-yourself DIY experience, may actually end up thinking equities is a bad thing or stock markets is a bad thing. I'd like to end this comment with a little example. If you see Mahabharata, right, and when the war was going on, right, and this whole Chakravyu was a difficult thing to penetrate, right, for the Chakravyu of Kauravas. And so Pandavas were making a strategy of how to break it, and the only guy who would have done it was Arjuna. And at that stage, the story of how to break into it was heard by his son Abhimanyu. He could only hear, right? The mom went to sleep, right, when they were discussing coming out of the Chakravyu. So Abhimanyu in the womb of the mother could only hear how to enter the Chakravyu. So he ultimately died inside the Chakravyu, right? And I'm just narrating the story because I think retail investors and most Indians would know Mahabharata, and the story of Abhimanyu, right? So doing DIY is like playing Abhimanyu. And my sincere appeal to all the investors would be to try and use the expertise of a manager. If you don't want to pay them fees, use index funds, which are very low cost. You can invest in a mutual fund at a 20, in a passive fund at a 20 basis points yield. You can invest in a small cap fund. You can invest in a mid cap fund. You can invest in a large cap fund. So don't worry about that. But ultimately, don't do it yourself. Read the story of Abhimanyu in Mahabharata. Rely on Arjuna to do it.
All right, we leave it there. Thank you very much, Navin, for sharing your perspective with our viewers, for taking time out to speak to them in these very difficult times. I do hope that you have a great innings ahead and stay safe, and your employees stay safe as well. Thank you very much for joining us here.
Thank you, Vivek. All the best.